Thanks for joining us at Power Lunch. This is BloombergQuint. I'm Harsha Subramaniam.
Good afternoon. I'm Ira Dugal. Let's get you the headlines. Indian equity benchmarks come off the day's lows but still trade 0.5% lower.
The Reserve Bank of India rejects Indiabulls housing finance merger with Lakshmi Vilas Bank.
Reliance Jio Infocom will now charge users 6 paise per minute for voice calls made to rival phone networks.
And IndusInd Bank will kick off second quarter earnings season today, followed by TCS in the evening.
All right, let's first take a look at how markets are faring. Yatin is with us.
Afternoon, Ira, and since yesterday we haven't seen much of activity, coming in. In fact, if you look at the key benchmark indices, most of them are down anywhere between 0.6% to almost 1% at this point in time. For Nifty 50, the advance decline ratio is also quite weak, 2 advances for every 3 declines. If you look at the top gainers, of course, telecom stocks are in focus. So we have Bharti Airtel, which has gained nearly 4.5%. Reliance Industries is also up by nearly 3% after Reliance Jio, announced that it will recover the interconnect usage charges from customers via additional recharges. Also, following suit is Idea Cellular as well as Grasim. Both of these stocks are also active on the back of that news. In terms of losers, we have private banks as well as PSU banks losing traction in trade. We have Yes Bank as well as ICICI Bank down about 3.5% odd. SBI also is down 2.5%, along with Tata Motors as well as GAIL, which are the other nifty losers at this point in time. In terms of active securities, watch out for the entire IT pack. Remember, TCS reports its quarterly earnings post the market hours today. So that stock is quite nervous ahead of the quarterly earnings. So is the case with Infosys. That is also one of the IT stocks which is down 0.5% at this point in time. Along with that, watch out for IndusInd Bank. We have an earnings press conference at 2 p.m. So probably in the next half an hour, we will also have the quarterly earnings for IndusInd Bank. Right now, almost 7% down for IndusInd Bank.
Ethan, thanks for that. Slowing growth dampens India's prospect for fiscal consolidation. That's according to Moody's. The sovereign rating agency says that given the already weak credit profile, the possibility of higher lending will weigh on credit profile as well. Joining us now on the phone line is the Managing Director of Sovereign Risk at Moody's Investor Service, Marie Didon. Marie, thanks so much for joining us. What are your concerns at this juncture as far as India's fiscal is concerned?
What we have highlighted is that the prospects for the government's debt burden, and government debt is currently about 68% of GDP, are reliant on sustained, relatively high nominal GDP growth. So real activity and some inflation in the economy. And that is because the fiscal consolidation, so really proactive measures by the government to narrow the deficit, is likely to be challenging. We've seen that for a few years in India, where there are significant spending needs and infrastructure and social and physical infrastructure, and revenue collection has disappointed. So the debt burden becomes really reliant on nominal GDP growth, and in the current phase of a slowdown, which we think is partly long-lasting, then what we are looking at is smaller prospect, lower probability of really a significant fall in that debt burden. Now we're looking at that debt burden to remain at around current levels for the next few years.
Marie, good afternoon. This is Ira joining you. Just wondering if you can share your view on the growth picture in India. It does look like you're seeing this slowdown is protracted. Domestically, the debate has been whether it's structural or it's cyclical. But I think the way you put it is that it's at least partly long-lasting.
We do think it is partly long-lasting. There are multiple causes, really, to that slowdown, and some of them go back to a few years. What we've seen over the last few years is financial stress, in particular in the rural sector, with low food price inflation, which, while positive for the economy as a whole, has probably compressed margins for the agriculture sector, and that is related to some stress. We've also seen weak job creation, in particular amongst the young, with a rise in unemployment, and that is also contributing to compressing incomes and depressing consumption. More recently, we think that the growth slowdown is partly attributed to the contraction in credit credit availability from the non-bank financial institutions, where the liquidity squeeze in that sector remains continuous, and that used to be a sector that provided significant amounts of credit to, in particular, retail credit, and so we've seen that slowing. We think that these factors are long-lasting in that there's no few prospects of really a rapid bounce back, a rapid resolution to this. And as a result, we've revised our forecast down. We now expect for this year GDP growth to be around 5.8% and then to rise slightly in the course of 2020.
Marie, it was about 2 years ago that Moody's had upgraded India, and at that point there were some assumptions made both on growth and the contribution of certain reforms such as GST to growth and then also to the fisc. Would you say that 2 years down the line some of those assumptions have not played out as you would have expected?
So some of the and that's the case for growth, we just discussed. 2 years ago, there were prospects of sustained real GDP growth at around 7.5–8%. These prospects now have dimmed. There were also prospects related to that then of a steady decline in the government debt burden, and we think that it is now less likely. What has remained, though, and that is an important factor behind the rating, is the structure, the composition of the government's debt, that is in local currency, that is at long maturities, and that provides really some stability to that debt burden. On the downside, we think the stability in that fiscal consolidation is really challenging, but on the upside, in terms of a higher risk of a higher debt burden, we also see a relatively low probability of a rapid ramp-up because of that financing structure, because it is fairly predictable. The costs of the governments that are fairly predictable because they are in local currency and the debt is at long maturity.
Okay. Marie, how does India compare to other peer economies? We heard the IMF chief talking about the fact that within the emerging market universe, the slowdown in India perhaps is a little bit more pronounced. Within your peer rating groups, how does India compare to others in terms of the growth picture particularly?
So the slowdown has been more marked, so going to now 5.8% this year, which would be 1 full percentage point lower than last year. When we look at other emerging markets in Asia, for instance, the slowdown is somewhat more tempered than that. It is, in the case of India, a slowdown from higher growth levels. 5.8% by international standards is still a very fast pace of growth, fueled by steady population growth and still rising incomes. It's also that the slowdown has really different origins. So in the case of India, the factors we've talked about are essentially domestic. It is not an economy that is particularly reliant on global trade, whilst in particular in the rest of Asia, what we're seeing is that the slowdown has a lot to do with global trade slowdown for economies like Malaysia, like Thailand, or other emerging markets in the region that are reliant on trade, on exports.
All right. Maria, last question. Do you also see policy space in India being a little limited? I ask because we've already seen the government expend some fiscal headroom via corporate tax cuts, which may not be immediately soothing for the growth picture. Also, the Reserve Bank of India has cut rates by more than 135 basis points now. So, terminal rates would probably be approaching fast. So is policy space limited?
So we've seen policy easing, as you just said, both on the fiscal and the monetary policy side. What we're watching for is really the signs of effectiveness of that policy easing. So on the monetary policy side, although the RBI has cut interest rates by 135 basis points so far, these cuts do not seem to be passed through, and so the cost of financing for the economy is not falling at the same pace. On the fiscal policy side, the most significant measure in recent months was indeed the corporate tax cut. We think that will have a slight positive impact on growth of around 0.2 percentage point. Space beyond that, scope for further easing is constrained by the government's objective to keep the deficit at relatively contained levels, and the longer-term objectives to reduce the debt burden. We think these objectives are increasingly challenging to meet, but we think they do remain as policy objectives nonetheless.
All right, we'll leave it at that. Marie, thanks so much for joining us here.
Thank you.
The Reserve Bank of India, meantime, has rejected the proposed merger of Indiabulls Housing Finance with Lakshmi Vilas Bank. The proposal was first announced in April this year. Vishwanath Nair has more details.
The Reserve Bank of India on Wednesday announced that it will not allow a proposed merger between Lakshmi Vilas Bank and Indiabulls Housing Finance as well as its commercial credit lending unit. According to a statement by Lakshmi Vilas Bank to the stock exchanges, the Reserve Bank of India has sent out a letter on Wednesday rejecting their proposal for the merger. Now remember that the merger was originally announced in April, where Indiabulls Housing Finance had proposed to take over Lakshmi Vilas Bank's businesses and thereby set its own management in the bank. Later on, a month later, it reversed that scheme of amalgamation and said that Indiabulls Housing Finance as well as Indiabulls Commercial Credit will be merged with the bank, and thereby that proposal will go forward. All companies had approached various regulators, including the Reserve Bank of India, for approvals for this merger to go ahead. After a wait of nearly 6 months, now the regulators finally saying that it will not let this merger go forward. Now remember that there were already questions being raised whether the regulator will consider this proposal at all, considering that Indiabulls Housing Finance has a large real estate business under its wing, which the promoters of Indiabulls had proposed that they will hive off that real estate unit and thereby make it easier for the regulator to give its approval. Clearly that has not worked in Indiabulls' favor, with the merger being called off. According to a statement that was given to BloombergQuint by Ajit Mittal, the group executive director at Indiabulls Group, he said that this is going to be some kind of a closure for Indiabulls Group, because it will stop putting all its energies and effort behind this merger and thereby focus on more long-term business needs that are necessary for Indiabulls Housing Finance's core business, which is lending to buy homes to customers in the market. The company as well has gone through a considerable liquidity constraint since the IL&FS crisis happened last year. The merger with Lakshmi Vilas Bank was looked at as a way to get past some of these issues, liabilities issues with deposits of the bank coming into Indiabulls' control. Similarly, for Lakshmi Vilas Bank, it has been facing considerable capital-related issues, because of which the Reserve Bank of India has put the bank under the prompt corrective action framework. They again believe that this merger could lead to some kind of capital infusion, which could help the bank come back into stronger footing. Now that the merger has been called off, it remains to be seen what exactly Lakshmi Vilas Bank will do to get out of the PCA framework and thereby become a more functional bank.
All right, and we spoke to former RBI Deputy Governor Anand Sinha and asked him if this was a signal that mergers cannot be used as a backdoor entry into the banking sector. Listen to what he had to say.
If the implication is that you cannot get a license directly through a proposal for conversion, and then if you are trying this route, both would have to be seen as equivalent processes, and therefore ultimately, it's a question of the two entities, what has been their track record on amalgamation, how the entity will look like in terms of financials, in terms of corporate governance, in terms of promoters, who are the people behind this, the fit and proper status. So these are the issues which are looked into.
We also spoke with the Vice Chairman of Indiabulls Housing Finance, Gagan Banga, and he says measures taken to comply with the RBI's bank license norms will only hold the company in good stead, and that the focus now is on AUM growth. Listen in.
Now that the uncertainty is gone, we can build on the wins of the last 6 to 12 months. Because we were working on the merger, our commercial real estate book has significantly run down. Our dependence on commercial paper, which same time last year used to be around 15,000 crores, is now down to less than 500 crores. And our sister company, Indiabulls Real Estate, is effectively a zero net debt company. We get back to being a housing finance company, which has been historically been compounding its book at about 20%. I see no reason why our loan AUM will not continue to compound at 20%.
All right, now this afternoon, actually shares of Indiabulls are down far more steeply than Lakshmi Vilas Bank. You got about a 16% cut on Indiabulls. Lakshmi Vilas Bank down 4.5% of nearly 5%. I think with reference to Indiabulls housing, the question being asked is that this is the second time the Reserve Bank of India has actually rejected their attempt to get into banking. The first time around, they were not within some of the limits stipulated by the RBI. This time around, they made an effort to reduce their real estate exposure. They said they will give up control, etc. Yet the RBI has rejected the merger plan. Now, as Macquarie put it, does this give a sense of the discomfort from the regulator for the promoter and the management? That's an unanswered question, but certainly one that would weigh on the minds of investors. Indiabulls housing down 16%.
Meanwhile, voice calls from Reliance Jio will not be free anymore, at least not to rival networks. The Mukesh Ambani-owned operator will now charge customers 6 paise per minute to make up for the interconnect usage charges, or the IUC charges. Somit is here to explain what's forced Jio's hand.
So if you say Reliance Jio will now start charging customers for voice calls as against its earlier made promise of ending the era of pay for voice calls. Now, Mukesh Ambani, during the launch of Reliance Jio in 2016, had assured that Jio voice calls across India will never be charged on any plans. However, Jio has now introduced IUC recharge top-ups vouchers in the range of around 10 to 100 rupees, and Jio will provide some additional data on these recharges. Now, these recharges have to be done if the customer wants to make a call to other rival networks. Now, why is it doing so? Because firstly, because TRI has floated a consultation paper to defer scrapping IUC charges. Now, this is said to impact Jio's EBITDA and benefit the other operators because Jio is still a net payer of interconnect usage charges. Secondly, since its launch, that is 3 years down the line, Jio has paid close to 13,500 crore rupees as a net interconnect usage charges to other operators, and now it has decided to recover these from users. How will it benefit? How will this move benefit Jio? Now, in the first quarter of financial year 2020, if you see, Jio had paid a net IUC of close to 720 crore rupees, that is 15% of its EBITDA. However, the gross amount was much higher as the number of outgoing calls on its network remains high. Now, as it will start charging customers now, the entire gross amount will be saved by the company. Now, if you see in the first quarter, a total of 40,000 crore minutes of calls were made and received from other networks. Of these, 64% was outgoing, which means that Jio had to pay an IUC of 6 paise on 25,000 to 720 crore minutes of call. Now, this translates into 1,543 crore rupees. Now, this would have been an entire saving for Jio in the first quarter because of these new tariffs. As against a revenue of around 11,700 crore rupees, this amount is close to 11%, while as against the EBITDA of close to 4,670 crore rupees, this amount stands at close to 30%. Lastly, what does it mean for other operators? Well, it is difficult to say at this point of time. Now, they have an opportunity to hike tariffs here, or else they can continue to keep this as a differentiating factor between themselves and Jio, as in turn this can help them to get in more subscribers, or at least save them the current subscriber base that they have.
Thanks so much for that, Sumit. We spoke to former CEO of Bharti Airtel India, Sanjay Kapoor. He reads Jio's move as proof that no operator can sustain a continuous cash drain on its books, but he doesn't think this marks the end of competitive pressures in the telecom sector.
This particular change in stance signals to the market that no matter whether you are an incumbent or whether you are a challenger, there is a cash crunch in the industry, and the revenues are not generating enough EBITDA and cash flows for the industry to sustain itself. And therefore, as long as on-net discounting is concerned, it's fine because there's no cash out. But on off-net discounting, where I have to pay cash to somebody else, that probably to be absorbed by any company seems to be a challenge. And therefore, Jio has come out and said, I need to recover this money from the customers. I think disruption and price war in this industry will continue as a pressure point till Jio, according to me, attains at least a 50% revenue market share. Why would they relent after putting in tens of billions of dollars into this industry and sit back and say, I'm happy with a one-third scenario? I don't see that stacking up.
Let's move on. Tata Sky has managed to make the most of the new TRA norms. The direct-to-home player has beaten peers to take the #1 slot in the quarter ended June this year. Sajid is here to tell us how the numbers stack up.
That's right, Harsha. The new tariff order has not only led to consolidation of subscribers who watch television or on either DTH or MSOs, but also led to consolidation within the players as well, especially in the DTH industry. In the quarter that went by, we saw the number of DTH players reducing to 4 from 5, with Reliance Group DTH being suspended, and also regulatory changes which respect to subscriber activity was also changed, which means that earlier, if the regulator considered 120 days of inactive subscriber as a non-subscriber, today it has been reduced to 90 days, and as a result of which we have seen a lot of compression happening with respect to subscribers who are part of the DTH platform. In the first quarter, we saw nearly 4 million of those subscribers coming down within the industry. If you look at paid DTH industry, we have seen a consolidation happening with a lot of Reliance customers moving into some of the DTH players, but also analog customers, especially in states like Tamil Nadu, where RSU Cable has a lot of analog customers. They have started moving to digital. We also have seen some free dish customers which were earlier enjoying some of the popular channels, and now that it become pay TV, they are also moving to the digital platforms like DTH and cable, and of course there's a shift from DTH to OTT platforms as well, which we are seeing. As a result of which, the market share has been changing a bit, and we saw in the first quarter Tata Sky's market share going up to 32% from 28% and Dish, which was the leading player in this market, coming to 31%. So as a whole, overall, even though the paid DTH subscriber base has gone up, Tata Sky has been able to consolidate much faster, and it was able to add 3 million customers in this quarter.
All right, thanks so much for that, Sajid. Second quarter is seasonally strong for IT companies, and they may have made the most of it. The top 5 technology firms by market cap are expected to report operationally strong numbers. Agam Vakil is standing by with the broad trends expected from the sector. Agam.
All right. Well, so I'm going to start off with the aggregate growth for the top 5 companies by market capitalization, which includes TCS, Infosys, Eatstar Technologies, Wipro, and Tech Mahindra. And we're expecting about 3.8% growth in rupee terms, EBIT likely to rise as much as 8.3%. Perhaps the strongest feature for this particular quarter, net profits expected to rise as much as 3.4%. In terms of the revenue growth, we're expecting to see large ramp-ups in terms of, a lot of deals which should aid growth, and we see broad-based strength across all verticals. But we must remember that there is a slowdown in Europe, which may well weigh down on, at least some of the important verticals, which includes BFSI. Acquisitions, on the other hand, will contribute to the sequential uptick. We also have to keep an eye on what the companies have to say about their assessment with respect to the slowdown in Europe and the kind of impact that has had. And we're also keeping an eye on the impact of talent supply crunch on costs, as well as both higher subcontractor costs. Deal wins and pipelines will be other key watchable too, as well as the integration of acquisitions and the merger strategy is something that we're going to keep an eye on. On the whole, it could be a steady quarter as far as the Indian IT is concerned, specifically with respect to the top 5 companies.
All right, let's talk specifically about TCS. The IT bellwether will post earnings later this evening, as Agam was mentioning. What's the market price in this time?
Well, no fireworks expected here, Harsha. We are expecting revenues to rise as much as 1.9%. As far as your dollar revenues go, in rupee terms, likely to see an uptick around 3.3%. We're also expecting an expansion in EBIT margins, that's operating margins, to the tune of somewhere around 90 basis points. Consequently, profits could rise as much as 2.1%. What we are watching out for as far as TCS is concerned is that there could be some client-specific issues, and that could hamper some amount of growth as far as your revenues go. European slowdown, the impact of BFSI, again, a very important factor because Europe is a reasonably large geography for TCS. We are also keeping an eye on retail vertical, which is expected to remain volatile, and of course deal closures, which are likely to be lower as compared to the first half of the current current calendar year. In terms of other factors, we are expecting, we're keeping an eye on demand outlook, order bookings, of course, specifically in the US and the banking financial space, impact of talent crunch on margins, again, something which is important, and contribution of the digital revenues to the top line. But as I've said, we're not expecting a very strong growth as far as TCS goes in this quarter.
All right, Agam, thanks so much for that. IndusInd Bank will report earnings anytime now. The merger with Bharat Financial will aid the lenders' margins, but asset quality will remain the key thing to watch. Shefali Malik is here with what the markets are expecting. Shefali.
Well, a muted set of numbers can be expected from IndusInd Bank this time around, with profit figure coming in at about 1,417 crore rupees. YY numbers are not comparable because of the merger with Bharat Financial. So on a QOQ basis, profit will be down by about 1% and net interest income will be up by about 6% to about 3,003 crore rupees. So that's again on a sequential basis of a growth of about 6% that's expected. Pre-provisioning operating profit is seen at about 2,598 crores. That again will be muted this time around. Some key metrics that we'll be looking forward to: loan growth is expected to be around 26% and deposit growth seen at about 22 to 24%. Margins, which saw a huge bump up because of the high yielding book of Bharat Financial this time around as well, is expected to inch up slightly to about 4.1%, and we can expect strong traction to come in other income as well. And we can expect the bank to use lower tax rates to improve its provisioning coverage ratio, which is at a very low figure of about 43%. So that's what we are looking forward to, and more importantly, asset quality will be the key thing to look forward to. Some key numbers that have come into focus in last couple of weeks. One pointed out by Moody's that their commercial real estate exposure is about 11%. So how that book pans out, that's the key thing to look forward to. Jefferies told us that Jefferies in fact put out in the note that their exposure to high risk corporates is about 2480 crore rupees, which is about 9% of the net worth of the bank. And also CV portfolio is something that we'll be looking forward to. In some of the worst cycles, the bank managed to hold on to the asset quality in that portfolio, but this time, as the auto slowdown is quite severe, how the asset quality pans out in that particular portfolio of the bank will also be a key monitorable. So that's what we are looking forward to from IndusInd Bank this time around.
Shwari, thank you for that. India will insist on measures to prevent dumping of goods as part of the Pan-Asian trade deal. That's according to what sources have told Bloomberg News. Remember, the Commerce Minister will attend a meeting of the Regional Comprehensive Economic Partnership in Bangkok on Saturday, and this will be a key to finalizing that agreement. Shruti Srivastava is standing by to tell us what's on the cards.
As November deadline looms to conclude the talks on RCEP, India is under intense pressure to make up its mind whether it wants to be a part of the deal or not. Now that there are indications that though India is willing to be a part of the deal, it wants certain of its key demands to be met. Essentially, what India is looking for is a safeguard mechanism to protect its domestic industries from influx of cheap Chinese products. Now, what it wants is an auto-trigger mechanism whereby it will be ensured that if it sees that import of certain items has increased in the country, it will be able to automatically raise import duties on those products. Now, the second thing which India wants is free movement of its skilled professionals across the 16 nations who are part of this deal. India has a huge and thriving service sector industry. It sends its IT professionals across the world. So it would want to give a further boost to its service sector, which is why India is insisting on having better terms and better deal for free movement of its people. The third thing which India is insisting on is better access to market in China. Now, India is so far not convinced by the offers which have been made by China in terms of market success. It's seeking better terms and better deal from China for getting access for its goods to Chinese market. Now, when it remains to be seen how much the nations would be willing to come forward and meet some of India's key demand. So it remains to be seen how much Mr. Piyush Goyal, the Commerce Minister, when he goes to Bangkok on Saturday, this Saturday, how much will he be able to negotiate with these countries, and how much would these countries be willing to give to India?
Sudhir, thank you so much for that. Out of time on the show. Thank you so much for joining us on Lunch today.